Hi, this is Joe Rabil from Rabil Stock Research with your Daily 5 today. Based on the current market action, I thought it was worthwhile to examine the general market, focusing in on the S&P using the spider in multiple time frames. When looking at the overall market condition, we want to make sure we look at market volatility. So let's go ahead and start with that. So this is going to be the first chart here. I've got the spider up, and I've got a weekly chart of the spider. I've put an 18 MA on this chart, and I also have overlaid the 18-month line and the quarterly 18 in red. So it just gives us a pretty good outline of where the big support levels would be based on these definitive lines, which I think 18 in any time frame can be pretty important, and has in the past, obviously, on the big drop in 2020, found support at the quarterly 18 MA. And if you notice, what's been taking place is every pullback over the course of the past year has held the 18-week line until recently. I'll get more into that as I go into the individual time frames. So what I wanted to focus in on first was the volatility. And at the bottom of this chart, I've got the average true range of the spider here. And we can see the black line is showing on a weekly basis what the average true range is for this index. It was around 9.5 back late last year, and has now climbed up to 13, 14 points a week. So that's a pretty substantial jump. That's a move in the S&P. Just to give you an example, that means the average range of the price during the week has gone from about 90 up to about 135 just in the course of a few months. And so that's telling us that when volatility is increasing, that the risk is also elevated. And I've drawn in these trend lines over the past few years just to show, when we break this trend line, how it does increase the risk in the marketplace. And we're in one of those times right now where we have a rising line above a rising moving average after breaking the trend line. So when we see that, we have to start looking at where, support levels are. And as long as this line is making higher highs and higher lows, we have to assume that there's going to be more volatility in the market. And the market has a hard time with volatility. I mean, when there's volatility, it typically means there's distribution going on. And again, that would increase our downside risk. So let's go ahead and get into the individual time frames, though, and start looking at the price, the trend, and the momentum in each time frame. So let's start with the monthly chart. And we can see that one of the key things that I wanted to mention here is this was the last time, back in early 2020, was the last time price of the spider touched the 18-month line. And if you notice, we've gone a pretty long way climbing up here without touching this line. And it just looks like it's due to me. And especially based on what's taken place here recently, it just seems likely that we're going to meet up. Now, it doesn't mean that it has to come down to it. It could just work sideways while this line moves higher and they touch. But I think this wants to touch. Now, I mean, if we threw up a fib grid on here, the 18-month line is actually lining up. If you use the low of this move and the high of this move, the 23% retracement is right about here. Now, if you use this bottom and this peak and do a retracement, then we get around a 38% retracement right around this level. So the low 400 area for the spider does have some other signs based on Fibonacci's that is giving us a sign that there should be some support here in the low 400s. Now, I like to assess the immediate momentum when we get to that point. And when I get into the smaller time frames, I'll talk about that a little bit more. But one of the things that I would tell you is that the momentum going in on this time frame is pretty good. The MACD has confirmed the new high, and the ADX has confirmed the new high with a pretty strong reading. So I am kind of predisposed into thinking that there is going to be support in this 400, 405, 410 zone if we come back down to that level. I think the key time frame to watch is the weekly. if we notice what happened, and I did a Your Daily 5 about 3 or 4 weeks ago and talked about this specifically. And one of the things that I think is important is that what I had been saying is, okay, we're trending to the upside. We've got a nice 18 and 40 rising up until this point here. But look at what was taking place with MACD and look at what was taking place with ADX. We knew there were signs that there was momentum loss. And then right around the end of the year, the volatility started to really pop. And we can go back and look at the volatility really popping right into the end of the year and showing significant signs that not only have we lost momentum in both MACD and ADX, but we were starting to see more volatility. So that was sort of the precursor to what was taking place. Now, I think a key to understand here is a trend line break does not mean that we have changed the trend to the downside. It means that we're in transition right now. And when I see a trend line break and then we get a rally and a test, I like to draw two lines in. We got a line here and a line here. And if we come back down, now that we've tested the 18, if we come back down through this line to the downside, we have confirmation, in my opinion, in a 1, 2, 3 sequence where we break the trend line, we test the high, and then we come back down through the low, that the trend is shifting. There's a very high probability that the trend is shifting to the downside. However, if we come back up through the 18 and fail to hold this resistance at the 18 MA, then I think we've turned neutral, and this transitional period probably extends for a while where we can end up just being in a trading range until we either exceed this high or exceed this low. And actually, I would tell you, if we take out this peak to the upside, then the probabilities are that we are going to come back up through this prior high at some point. So I just think it's really key to watch this 460 area, 457, 458 area on the spider. If we come back up through that area, then I think the weakness in the near term is probably going to subside, and we get into an environment that is not going to be easy, but maybe not have immediate downside risk where we could really blow it out to the downside. So I'm kind of keying on that right now. If we look at the daily chart, we've got the moving averages are moving to the downside. We've got an 18 and a 40 where the 18 is below the 40 and both lines are declining. Now, I mean, I've already outlined this key level up here, this high. And if you did a retracement, if you took this peak and this low, the retracement is 618. So that's the 62% retracement right here. And if we take that out to the upside, I really think that tells us that the weakness that we've been seeing recently is probably, again, going to subside. And this is going to turn into a much more choppy sort of sideways trading range. So I'm watching and keying on this 618 level for the retracement, which happens to be the 40-day MA as well. If we see that take place, then green DI should come up through 25 and cross back above the red DI. And again, that would be more of a sign that the sellers are losing control here. Our last chart is the hourly chart. And one of the things that I wanted to see take place that would be, I think, pretty confirming evidence is now that the 18 has crossed down below the 40 and we're rallying into the zone here. What I want to see take place, if this is really a bearish trend, we should fail somewhere in this range below these moving averages, below this 40, and turn back down and take out this low. And red DI should hold above green, and we should turn back to the upside. If we get that taking place and we get that move to the downside, it's going to put pressure on all the other time frames. It's going to put pressure on the daily chart and suggest that we're failing to get back above these levels, which are key. And we're probably going to start pursuing a full-blown test of the lows that I think are pretty important criteria when you look at the overall trend here. Because if we take out this low or this low on the hourly, that's this low on the weekly, and that convinces me that we've done a 1, 2, 3 sequence on the weekly chart. So these are the types of things I think you should frame out the market. I'm not a big fan of trying to predict. I think you want to do really good analysis, look at the price trend, look at the momentum, make a decision and frame it out as opposed to trying to really predict in advance. If we get the shorter term time frames to turn down from here, then I think the risk really increases dramatically. If we break through this 40 and end up working our way back up through this higher time frame or the daily chart and getting back above this resistance zone, then these bigger charts don't look quite as ominous to me. So keep these key areas in mind, see how the price reacts here. We're starting to give back a little bit this morning, but we're still have a pretty big gap up. If we come back down through this open level this morning, or I should say yesterday's closing level, I would say that would be a pretty big negative. So something to keep an eye on over the next day or two. Hope you enjoyed this segment. You can contact me through LinkedIn or find my research on rabilstockresearch.com. In addition, if you'd like to learn more about trend, MACD, and ADX in multiple timeframes, I do have a YouTube channel and a book called Invest Like a Pro, which delves into this subject. Have a great trading day, and I'll see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.